Hey everyone, welcome to the new video on my channel, and today in this video I'm going to do something really exciting and different, and that is I am going to show you all an option buying setup. You might be wondering, since I'm a hardcore option seller, how can I even show you any kind of buying setup? One thing what you have to note is that if particular setup is not working for me as a seller, most likely that would work for you as a buyer. So this setup is mainly for people having smaller capital. So I'm just not going to show you the setup. Rather, we are going to discuss what exactly the problems option buyers face and how we can tackle them step by step. So I'm not just going to share the setup. Rather, first we are going to discuss about the problems what option buyers face. Post that, we are going to discuss solution in detail. So we'll start addressing each one of the problem one by one, and then we are going to automate the entire setup for option buyers. So one very important thing to note is whatever setup I am going to share now is applicable for the current VIX environment only. So as and when the VIX environment keeps on changing, let's say currently we are trading with around 10 to 12 VIX. Tomorrow if the VIX becomes 15 or 20, maybe this setup might not work. So it is very important for you to note that you have to keep changing with time. So a particular strategy or a particular setup will not make you money all the time. So whatever I'm sharing now is actually making money in the current environment, because for an option seller like me, this particular setup is actually losing money, and that's why for an option buyer this would be mostly making money. This video will be divided into various parts. In the first part, I'll be discussing about the main problems option buyers have and what can be the potential solution. In the second part of the video, let's build a strategy based on the problems we have addressed, and let's backtest the results. And finally, in the third part of the video, I'll be showing you how you can automate the entire setup so that you don't even have to sit in front of the screen to have an option buying setup which can make money for you. So again, it's a very important thing to note that I am not SEBI registered and I can't recommend any strategies to you. All I can do is give you a framework. So what we are discussing right now is just a framework based on which you can start building your own strategies and backtest them and also automate them. So don't use it as a strategy by itself, but rather use it as a framework based on which you can start building further strategies, improvise the existing strategy, and make more profit. So now let's quickly get onto the screen recording where I'm going to discuss the solution to the problems option buyers have, and we are going to build a strategy around it. Before moving on, there is a very important thing which I would like to tell you. So as you all know, we have an automation platform called as finarget. Today, whatever buying setup I'm sharing with you can be also automated absolutely for free using finarget. So any number of strategy execution is going to remain free on finarget with a Firstock account, and Firstock is also offering a special discount where you get 2000 rupees additional brokerage credit by opening the account using the link below in the description. In case if you're interested to use finarget for free and automate all your strategies with zero brokerage for the first 100 orders, make sure that you click on the link below in the description and open your Firstock account. Now let's quickly move on to the video and build the strategy. Hey guys, welcome to today's video, and today in this video we are going to build a intraday option buying setup. And in this setup, you don't have to actually look at the charts at all. We are going to rely on the option price momentum to take our entry and exit. And entire system can be automated. You don't even have to sit in front of the system. And I'm also going to show you how. It is also very important that you actually stick till the end, because towards the end, we are going to discuss about risk management and position sizing. And this is the most important topic as an option buyer, because most of the option buyer lose majority of the capital in not sizing their position right. So this buying setup can give any percentage of return, but it is very important to make sure that we have a position sizing right. So when we start building this setup, it becomes really important for us to understand what are the main issues that the option buyer face. And based on this, we'll try to find a solution. And the first and the most important issue is the theta decay. As an option seller, since all of you know that I only sell options, so let us say I sell a call option trading at 50 rupees and I sell a put option trading at 50 rupees. So for me, I would want the market to consolidate in the range, and if the market actually consolidates in the range, I am going to make money from theta decay as a seller. But this is the biggest enemy of any option buyer. So right over here, I have put 5-minute chart of Nifty and we are replaying the chart. And this is the time around 12 o'clock. So let us assume you were bullish on the market at this point because multiple times the market had taken support. Again, here the market had taken support, here it took support, and here again it sort of took support. So most likely, let us assume that you were actually bullish on the market. If you enter a call option right over here, assuming that the market is going to go up. So if the market actually goes up, you will end up making money. But if the market ends up taking some time to go up, you will lose money because of theta. So let's try to see what exactly happened to the market. So as you can see, the market unfortunately started to crack. And by this time, you would have almost lost 50% of all your option value. Then you can see after 2 full hours, the market finally ended up at a day's high. But at this point, it is very hard for you to hold the same option buy because most of the value would have got eroded because of theta. And one very important point for us to note is whenever we are buying options, we don't randomly buy options with a hope that, okay, now the market is going to go up or now the market is going to go down. So it is a very wrong thing to do that trying to predict the market, it is going to go up from here or go down from here and randomly enter the market. Rather, let us try to catch the momentum, right? So let us assume there is a call option trading at 50 rupees and there's a put option trading at 50 rupees. If the market is consolidating, what will end up happening? So this 50 rupees will become 45 rupees. This 50 rupees will again start to fall. It might also become 40 rupees, 45 rupees. So if the market is not trending, we don't have to buy the option. Let's assume the market actually starts to trend in one direction. So it can either start to trend upside or it can either start to come down. In this case, let's assume the market starts to go up. So this call option from 50 rupees slowly will become 55 and slowly it will start to gain some more momentum. It becomes 60 and slowly from 60 it goes to 65 and then it suddenly gains more momentum. It goes to 75, 85 and 90. The 50 rupee option can easily become 65 or 70 rupees if the market is in momentum. Whereas this put option on the other hand is going to go down to 45, then it goes down to 40, then 30 and so on. So it is very important for us to understand if we randomly enter both put option and call option, we are going to lose money because one side it is going to go up, whereas the other side it is going to give us some loss. So there is no point in randomly buying option. Rather, let us try to enter options which is having momentum. Either call option will have a momentum or put option will have a momentum. So what we are going to do, let's say, so in this example, I'll just be giving you a framework. Again, note this is not a strategy, but this is just a framework which you can use and build your strategies. So in this example, let's take an option trading around 50 rupees. So let's wait for option to go up by 10 points. So if it is trading around 50 rupees, let it cross 60, then we are going to enter the call option. Or if it is trading around 45 rupees, let it cross 55 rupees, then we will enter the option. So in this case, if the option is trading around 50 rupees, we will wait for the option to cross 60 rupees, right? So we are not going to randomly enter into the option. We'll wait for it to cross 60 rupees and only then we are going to take the entry. So by doing this, we obviously cannot avoid theta decay. So this is a factor which cannot be avoiding, but will be reducing the effect of theta decay. But if you enter an option which is in momentum or which is moving quickly, the effect of delta on the option is going to be much higher than theta. So gamma and delta together is going to influence the option to go up much faster than theta reducing the value of option. And that is the reason why we will be choosing option with momentum. While we build this strategy, I'm also going to show you how you can easily automate it side by side. So it is just going to take you few minutes. So I'm just going to go to fintarget.in. So right over here, I have logged in and it's a free to use automation tool. So here I'm going to click on create new and I'm going to name this as Nifty buying setup. So we'll enter this strategy around 9:20, and our initial setup here I'm going to go for Nifty and select closest to premium. So I want to pick options trading closest to 50 rupees, right? So I'm going to put call option buy and put option buy. So I'm going to add the leg. So I want to buy the call option and put option trading closest to 50 rupees. So here I have just chosen 9:20 because it is the starting of the day. So since I'm just giving you a framework, you can change it to 10 o'clock, you can change it to 10:30 as per your convenience. Just do a simple backtest, see how the system is performing, and then you can change the time. So here I am going to actually use a feature called as wait and trade. And this is the most important feature which is actually going to help us enter the option with momentum. So I'm going to choose points up by 10. So again, I'm going to enable wait and trade for PE. So I'm going to choose points up by 10. So what exactly am I doing here? I am basically telling at 9:20, pick a call option and put option trading around 50 rupees. But do not enter immediately. So wait for the option to go up by 10 points and only then take the trade. So this is a very important thing to note. So in this case, I am not entering the option immediately. Rather, I am selecting the option and waiting for the option to go up by 10 points. So this is the first step where we choose the options with momentum. So now comes the second and the most important thing, that is to have the right exit with good risk to reward. So any option buyer would tell you that the probability of making money by buying options is very less. So hardly around 30-35%. We need to make sure our risk to reward is very good. If your stop loss is like 5 points, you should be at least looking for 10 points target. So whenever you are buying option, it is very important for you to make sure that you have a fantastic risk to reward. So let's take an example where your risk is 5 points. So it is advisable that you have at least around 10 to 15 points of reward for a 5-point risk with option buying, right? So if you are taking a risk of 10 points, it is advisable for you to have a reward of anywhere around 20 to 25 points. So in this example, let's take a SL of 20 rupees. That means we should be looking for at least 1:2 target. Otherwise, we are not having good risk to reward. So anyways, we are entering an option with momentum. We are keeping a 20-point SL. So our target should be at least around 40 points, right? So now we have a SL at 20 points and target at 40 points. So now let's go to fin target and place the stop loss and target. So we'll place our stop loss at 20 points for both the legs, both C and P, and we'll place a target at 40 points. So 1:2 is what we are looking at. And here, one more very important thing to note is when you're using wait and trade, both call option and put option will not be entered at the same time. So for example, let's say the market starts to go higher. So this call option is going to go from 50 rupees to 60 rupees. So fin target is only going to enter the call option without entering put option. On the other hand, so let's say the market starts to fall. That means the put option is actually going to go from 50 rupees to 60 rupees. So we have put wait for it to go up by 10 points. So this put option is going to go up from 50 rupees to 60 rupees. So in this case, only put option entry will be made, will be having a stop loss and target, and call option will not be entered. So fin target is going to take care of that. So you don't have to worry about that. So 9:20, we are going to start looking at options trading around 50 rupees. The moment one option becomes from 50 rupees to 60 rupees, we are going to enter the option with the momentum. So we are not randomly entering the option. Once it comes into the momentum, we are going to enter the option, keep a stop loss of 20 points and target of 40 points. So now we'll also try to see how we can further optimize our system, and this is to improve our risk to reward by keeping a trailing stop loss. So I'll call it TSL or trailing stop loss. So what will happen as and when the option price starts to move higher, even our stop loss will start to trail. Slowly the stop loss will start to come up. And this is a very important thing to have because this will massively increase your risk to reward. Imagine the option actually goes up by 10 or 15 points. Your stop loss will be trailed by 15 points. That means now you have a maximum loss of just around 5 points, whereas you have a target of 40 points. Suddenly your risk to reward became 1 is to 8. Assuming the option which you entered at 60 goes to 80 rupees. So it has gone up by 20 points. Because of this, your stop loss has now been moved to cost, which means you will never enter into a loss. So that's the reason it is always good to have a trailing stop loss, because as and when the market starts to move in our favor, so our risk to reward only keeps on increasing if we have a trailing stop loss. It's always wise to have a trailing stop loss with any setup. So I'm going to keep 1 is to 1 trailing. That means for every 1 point the option moves in our favor, our stop loss is also going to move up by 1 point. So now you can see that this is a fairly complex system. So we have target, we have stop loss, we have trailing stop loss, we have wait and trade, we have closest to premium. So it becomes really hard for us to execute it manually because there are so many parameters which we have to look into, and that's the reason you can simply automate it. So right over here we have considered multiple factors starting from the theta decay, then the low probability, then good risk to reward, how we can optimize our risk to reward further, and we have built a basic system. So now we are going to backtest the same system and see how it has performed over the years. So first we are going to see for last 1 year alone. And to backtest, we'll be using Stockmock. So I have also attached the link in the description below for Stockmock. So you can actually open the account using that link and get 20 free credits. So right over here, you can see that I have already finished the setup. So 10 points wait and trade, 40-point target, 20-point SL, 1 is to 1 trailing stop loss. So we are going to go for Nifty options, and then the time is 9:20 and the exit time is 3:29. So we are going to test for last 1 year, and I'm going to click on start backtest. So not very often you get a positive expectancy with an option buying system, but in this case you have actually got an expectancy of 0.14. So what I'm further going to do is try to optimize it further. So let us try to remove 4 DTE, let us try to remove 3 DTE, let us try to remove 2 DTE, and only work with 1 DTE and 0 DTE. So we are only going to use this system on Wednesdays and Thursdays because that is when the overall time value of Nifty options is going to be the lowest. So this 50 rupee option is going to have the least time value on the expiry day and 1 day before expiry. So by doing that, you can see that suddenly so many things change, right? So your overall profit goes up to 751% in the last 1 year alone. So we are not even talking about 2 years or 3 years. So in the last 1 year alone, you have made 751% with an expectancy of 0.42. So you can see that you have improved your probability. By default, an option buyer generally has a probability of just around 33-35%. But by looking for options with momentum, you have increased your probability to 52%. And this is a fantastic probability for an option buyer. And not just that, you can see your risk to reward. On an average, you make close to around 1200 when you're right, and you lose 680 rupees when you're wrong. So that is a risk to reward of almost around 1.8. So now if you have a system which has 52% probability and 1 is to 1.8 risk to reward, so that means you're definitely going to be profitable. So if you take a look at it, in the last 1 year, you have just 1 month which is a loss making month, and that is December of 2022. Apart from that, this system has made profit in every single month. When you actually look at it, you can see your profits are much bigger than your losses. So you can see your losses, they are very, very small. But when you get profit, you get huge profit. And when you further come down and take a look at the cumulative profit, how exactly the equity curve has been. So you can see this is a fairly good equity curve. So you have not gone to any big drawdown at any point in time. This equity curve has slowly and steadily given you profits. So you can come down and see individually how the entire strategy has performed. So what I'm going to do here is now I'm going to backtest for 2 years. So again, it is very important to understand these systems are going to work in certain market conditions. This might not be the best system to use when the VIX is at 15 or 20, because that time these options will be far OTM, right? So right now we will also take a look at how exactly it has performed in the last 2 years. In my opinion, this system will not be performing well if the VIX is very high. So let's quickly change this to 0 DTE and 1 DTE. So you can see the expectancy has actually dropped from 0.42 to 0.24. And when you come down and take a look at it, you can see in the year 2023, this system has given you a return of 700%. Whereas when the VIX was higher, this system has given a return of only around 120%. So you can see that the performance is not that bad. So overall, in the past 24 months, 19 months have been profitable and only 5 months are loss making. So now we'll just save this strategy, we'll enable the strategy, and you can also select the broker with whom you want to execute. So in this case, I'll be selecting a Firstock broker. So you can simply log into your broker and start executing your strategy. So you can also open a Firstock account by clicking on the open account button in the website above, and you will be getting 2000 rupees worth free brokerage credits, and you can also use fintarget absolutely for free. So one very important thing which we forgot is we are not going to execute it on all days. Rather, we are only executing it on Wednesdays and Thursday. So this is something which I forgot to change. And what I will also be doing is I will share this strategy with all of you. So I'll attach the link in the description below. So you can simply click on that link and this entire strategy will be pre-built for you. So you don't have to sit and build the strategy. Whole thing will be pre-built. You can just change the lots, save the strategy, and start running it seamlessly. Now comes the final part and the most important part, that is further optimizing this system to make the best version of its own. So right over here, you can see that this system was performing really well when the VIX was actually low. And once the VIX became high, the system performance started to deplete. So we can see that quite clearly right over here. So what we are going to do is we are going to add one more filter to make this system work really well under the best circumstance. And that is, we are going to use this system only if the VIX is between 1 to 14. So if it is under 14, only then we are going to run the system. So now the moment I click on refresh, so you can see what exactly ends up happening. Every single thing changes. So you can see that you had a max drawdown of 9,000 rupees and expectancy of 0.24. But when you run this strategy, when the VIX is under 14, you can see that your max drawdown is just reduced to 3,000 rupees. So suddenly the strategy becomes much more favorable. And also, not just that, you can see your expectancy has suddenly shot up to 0.52. So when you originally built the strategy and tested it for 1 year, it was just 0.42. And when you actually looked at it for 2 years, it was 0.24. But just by changing a small parameter, that is running this strategy when VIX is under 14, gave you a fantastic option buying strategy, which has a probability of 54% and almost 1 is to 2 risk to reward. So not just that, let me show you one more very important thing. So right over here, let me just change this back to 99, and you can see if you try to run this during all VIX condition, so the drawdown actually went on for close to around 210 days, or 152 days was what it took for recovery. But when you actually run it when the VIX is under 14, your overall drawdown just comes to 22 days. You can see how we were able to optimize the system. So you can use the same framework and start automating your trades for free using FinTarget. So I hope this system was useful. And now we'll be moving on to the final and the most important part, and that is with respect to your position sizing. So you can see that right over here, it is showing you a return of 720%. So right over here, you can see that it is showing you a return of 720% in the last 2 years. But to be honest, as option buyers or any option trader, nobody is really looking for returns of 300%, 400% a year. And this is not a reasonable expectation to have also. So now I'm going to share how you can position size in a much better way such that your returns are going to be limited, but your risk is also going to be limited to a great extent. So here the margin required is around 4,000 rupees per lot. But what I would suggest is instead of using 4,000 rupees per lot, use 40,000 rupees per lot. So do one lot of this strategy for every 40,000 rupees in your account. So if you have 80,000 rupees in your account, so then you can do two lots. So similarly, if let's say you have 1,50,000 in your account, you can do something like four lots. So right over here, you can see that in the past 2 years, you have got a return of 720%. So this is the total returns what you have gotten past 2 years. If you are using 40,000 per lot, instead of 720%, you are going to have a return of 72% in the past 2 years. So that means this is also an average return of close to around 36% a year. In my opinion, 36% a year is a fantastic return because it is almost close to around 3% a month. But also note that this does not include the cost of brokerage. So Firstock is already giving 2,000 rupees free brokerage credits, so you can make use of that and automate your system. And one more important thing also to note is that if you're doing with more number of lots, it is going to work out much better. So what is more important than the overall return is the risk. So previously, during the time of max drawdown, you had a risk of 74%, and this is a really high risk. Just by making this small tweak where you have one lot for 40,000 rupees, you're actually going to reduce the max drawdown from 75% to just around 7.5%. So 7.5% as the worst case drawdown, that too in an option buying strategy, I feel it's a pretty decent number. So you have almost around 36% yearly return and 7.5% drawdown just by changing your position size. So if you want to be more conservative, you can simply go one lot for every 80,000 and so on. So if you are trying to go more than that, I have also suggested a selling system. Maybe if you are looking for capital over 1 lakh, you can also use the selling system. So I'll be attaching the link in the description below. So in case if you're looking for any option buying setup or framework to build any setup, I hope this video was actually useful. Make sure you hit the like button, share this video and subscribe to the channel. And also, you can check out our Telegram channel down in the description below. And also, I have attached the strategy link in the description. So just click on the link and you will have the entire strategy pop up for you. So you don't have to sit and build it. Check out fintarget.in, start automating your trades from today. So you can also check out our option selling setup, which I have shared last week. So this is an option buying setup. So with that, we also come to the end of this video. Happy trading, guys, and have a fantastic week.